RBC Global Asset Management, and I'm sure you've heard by now, Eric, that the competition is offering a 5-year fixed at 2.99%. How low can these things go?
Well, boy, I think we've had to revisit that assumption any number of times over the past few years and even over the past few decades. Keep in mind, this rally in rates, this decline in bond yields and mortgage rates has been pretty persistent, not just over the last month, not just over the last year, but dating back to the early 1980s. So it's been a pretty incredible phenomenon. Anywhere along the way, people probably would have said it's got to stop soon. I will perhaps dubiously make that comment yet again, simply insofar as you're now getting down to levels that are astonishingly low, that are at least in the underlying government bond yield, which is really the benchmark that banks are setting their mortgage rates off of. Those rates will struggle to go much lower. There's a negative real return. So it's incredible for the average home buyer. People looking to get into the market clearly do wonderfully well. The reason mortgage rates are as low as they are is in part, of course, central bank rates are rock bottom. In part, there's a safe haven bid, so bonds in general and bond yields are low. And I wonder whether there's a bit of gamesmanship going on because it looks as though Canada's mortgage market is starting to slow a little bit, and so perhaps there's some market share considerations as well.
Eric, that's what I wanted to pick up on. I mean, why is the bank offering this presumably great deal? A lot of people would read it as such. What's in it for them?
Right. Well, I can't comment on the specifics, and I suppose more generally I can say mortgage rates are jaw-droppingly low across the board, regardless of the institution you particularly look at. I don't know the pricing schemes in particular, but again, the broader message is really one in which if you want to buy a house, the mortgage rates are unbelievably good. The question you have to ask yourself is whether the affordability is all that good given where home prices are right now, and that's been the twist. When I do my math, it looks to me as though indeed, you can get a reasonable monthly payment these days relative to household income, so all looks well, but recognize, of course, if you disentangle this, the only reason it's affordable is because rates are so low. If you ever think rates go back to normal and you have to refinance that in 5 years' time, home prices may well look a lot less attractive.
Yeah, but where are house prices going? We're getting conflicting information these days. Some people say there's a bubble possible in Toronto and a bubble in Vancouver. Others are saying the prices are going to continue to track upwards. And when we're talking the types of prices that you have to pay now for a house in a major city in this country, that's a lot of money.
I think it is fairly clear that home prices are overdone, at least in certain urban areas. The math I've done says if you ever return to normal interest rates, home prices are 15% plus too high. Now, that doesn't mean home prices need to drop by 15%. There are lots of ways this can be dealt with. It could just be that home prices stagnate for a few years, household incomes rise to meet it, and it's all ends reasonably benignly. I don't think we're going to see much of a correction if we do get one until interest rates start to rise, and so that's a question for the Bank of Canada. They will perhaps begin to answer next week, and the short response is that we probably don't see rates go much higher this year, and in turn the housing market probably hangs on at least for a little longer.
So Eric, just a question. I mean, we've now got such great deals for consumers, those who need a mortgage, 5 years fixed at 2.99 is the rate. Yet on the other hand, are banks not also debating getting rid of products such as those 25-year mortgages as well?
Well, I think that's a question for regulators more than for the banks at this point in time. And it's part of a broader discussion, which is to say rates are incredibly low. It's creating distortions in the housing market of the sort that I've just mentioned. Maybe this isn't such a good thing. How do we deal with it? The Bank of Canada doesn't want to raise rates. They still want the broader economy to move forward. And so you try and target measures specifically at the housing market. And we've seen a lot of that over the years. We've already seen that maximum amortization period come down from 40 to 35 to 30. So there's talk perhaps it goes to 25. You could do any number of other things as well. But I think the idea there is just to say, let's make sure this housing market doesn't get too out of hand. We saw what happened in the States. It's very unlikely to happen in Canada because the underlying metrics aren't nearly there, but we do have a bit of an issue, and let's address that.
He is the chief economist at RBC Global Asset Management, Eric Lassell. Nice to see you, sir. Thank you.
Thank you.